Hey guys, today we are gonna calculate all the stock terms using Excel. So if you're an investor in the stock market or you have seen a term such as EPS, PE, volume, book value, and you don't know what it is, stick around because this video will be of great value for you. I have an Excel spreadsheet prepared for you and we are gonna calculate all those terms. In yellow, they are usually provided. And once they are not highlighted, we will need to calculate, but they are also usually provided. But as in terms of this video, we will calculate them. For that, we need the stock data. Let's just use Google Finance now. Yahoo Finance. If we go to Yahoo Finance, you can just search in Google Yahoo Finance or write finance.yahoo.com in your search bar, and they will take you to this page and you just search the company you wanna know more about. For that example, let's just try Google, which is the ticker symbol Google, and the name of the company is Alphabet, and let's go through Google. The first term is the stock price, which is an easy one. Basically, if you want to buy the stock of Google right now, how much you will have to pay. Whether it is the right price or not, it's up to you, but as of right now, how much you will have to pay for Google. So I will just copy and paste on my spreadsheet. Our second term is shares outstanding. In other words, into how many pieces the company has been broken into. Okay, which is the total number of shares that exists. To get that number, we will need to go to the balance sheet. It will depend on the site you are, but usually in your finance, in other sites, they are reported on the balance sheet. Okay, you go to financial and then click balance sheet. At the bottom of the balance sheet, you will see the numbers of shares outstanding. I will copy and then paste. One thing that I should highlight though is these numbers are all in thousands. So it is actually not 12 million but 12 billion shares outstanding. So there are 12 billion shares of Google out there. All right. The next term would be market capitalization or market cap, which is the value of the company right now, and it's actually an easy term to calculate. You just multiply the stock price by the numbers of shares outstanding. So as you remember, it's actually in billion, the numbers of shares outstanding. So the market cap is actually 2.1 trillion. And usually the market cap you don't have to calculate, it's like straight away reported. If I can find the market cap, okay, if you see it's 2.1 trillion as we calculated. The next term should be the revenue, which the total money a company makes from selling its product and services. So how much the company is bringing in. This is reported. You have to go to the financial and then into the income statement. It's usually the first number that they are gonna report. In our case, you see, I will just copy and paste, okay, which is $359 billion of revenue in trailing 12 months TTT. So this number was taken out of the most recent report. The next term is the income, which is the money a company makes after paying the bills, taxes, and so on. You can actually calculate this number. You basically take the revenue and take off all the cost of goods sold, but this number is usually reported as well. So if I go to the net income, and then I have my number here. So I will just copy the net income and paste. Okay, again, that's 11,110 billion dollars. Our next numbers is the EPS, earning per share. This is actually an important number. Maybe I should highlight as well, because it's your money. So it's the amount of profit the company makes for each share. So if you are a shareholder of the company, okay, your earnings is the EPS, right? So it's usually called EPS or earnings, and it's your money. Usually the company will give you that money in forms of dividend, or it will reinvest into the business. So to calculate DPS is actually simple as well. It should be equal to the net income over the number of share outstanding. Okay, because the EPS is important number, it usually reported as well. If we go to the summary, we should have the EPS somewhere here. Okay, if you see, EPS is 9.09, which is exactly what we calculated. The other number is the PE, price to earning ratio, which is one of the most important terms you will have to know when buying a business, which is how much investors are paying for each dollar the company earns. Let's just calculate and think about the price to earning ratio a little bit more. So the PE ratio is basically the price of the company right now divided by the earnings, the EPS, which is 19. And this is usually reported as well. Okay, if you see in this summary page, they calculated for us 19. And the way you can think about it, for every $19 I pay buying stock of Google, I will have $1 of profit. Okay, so you pay $19 and you only have $1 of profit. Whether you're gonna buy the stock or not, I'm not a financial advisor. So that's how you think about the PE ratio. Our next number is the volume, which is just the number of shares traded each day. In other words, the number of shares that are bought and sold each day. I mean, for an investor, it's not really important. It's usually important for traders, but if there is not much volume, you are not gonna be able to sell your shares. And this is reported usually by the stock exchange. If you see for Google, if we go to the summary page, the volume is reported. So I will just copy and paste. So our next number is the dividend rate, which is basically how much dividend the company pay for each share. It's usually reported as well. If you see here, we have the dividend, so for dividend, and then we have the dividend yield that we are gonna calculate next. So for each share, they only pay 0.84 of dividend, so 84 cents of dividend. Okay, so you will receive 84 cents for each share each year of the company. And then we have the dividend yield. So basically, out of is a percentage term. So the dividend rate, it's a dollar term, and dividend. So I should maybe format to currency. Okay, dollar rate. Okay, United States. Okay, so we have dividend rate. So the dividend yield should be basically equal to the dividend rate divided by the stock price, which is actually a percentage because it's formatted. Dividend yield should be a percentage. I will format again, and then number percentage. Okay, so basically it's a percentage, it's formatted for us, and you see it's what is reported here. Or you could have just done the dividend rate over the stock price times hundreds, but we have a percentage here. Okay guys, so the next term is gonna be the debt to equity ratio, which is a measure of how much debt a company has relative to its total equity. In order to calculate that, we will have to go to the balance sheet again. So I will go to the financial balance sheet and then just try to get the total debt. In that case, they give the total debt for us, but if they didn't report, we will just look for all the terms that has debt in it, and then we sum all the terms. And then, for example, they have like current debt and capital. Let's see, okay, current debt and capital lease obligation. Okay, you just look for all the terms with that and then divide by total equity. But we have the total debt reported, which is nice. So I will just copy, which it should be equal to the total debt over the total equity of the company. In other words, basically you take the total asset, take off the total liability, and you have your equity, but they give us the total equity. I will just copy it and then paste in our formula. I should have removed the commas, but they have done that for us. And then we have the to equity ratio. So it's not a percentage, it is a ratio. Okay, and usually what you want is like a company that has debt to equity ratio less than 0.5, because ideally you want to have enough asset to pay its debt. In that case is 0.07, which is actually very good. The next term is the book value, which will be actually the equity that you own in the company. So basically it's just we are already in the balance sheet, because you have to go to the balance sheet. You take the total equity and divide it by the numbers of shares outstanding. So with the number of shares outstanding, again should have removed the comma, and then we have the book value. So you own 26 for every share, you own 26 of book value. Okay, so the next term is price to book value, which is actually a more useful term. It compares a company market value to its book value. So it's actually very easy to calculate, and then we will think more about what's price to book ratio. So I have the book value. Actually, I have the price of the company right now and divide it to the book value, which it comes up as 6.71. It should be ratio. Let me just format all those terms to general. Okay, and then it's a ratio. So how do you think about price to book ratio? The way you think is, for every $6.7 I pay buying the stock of Google, I get $1 of equity. So basically, if you buy Google right now, you are paying 6 times the actual book value of the company. Okay, not a financial advisor, but that's how you will think about price to book ratio. Okay guys, so the next term is the equity ratio, equity growth in that case. So it will actually depend on the time scale you want to calculate, but it's how much the equity of the company has increased in the range of time you want. Okay, maybe just for example, let's just calculate the equity growth from 2023 to 2024. What you do, it's gonna be equal to the equity at the year you want to calculate, so it's 2024, which is equity at the end of the period you want to calculate. It should be minus the equity of the beginning of the year you want to calculate, divided by the equity at the beginning. So let me just, it didn't remove the comma for us. I will just remove the comma. Okay, and then we have the equity growth, and this number is actually a percentage, not a ratio. So percentage, and then I have the equity growth. Okay, it has grown 14% since 2023. Okay, the next term should be the return on equity, which just tells you how efficiently the company uses shareholders' equity to generate profits. Okay, and to calculate that, it's actually very easy. It is equal to the net income. Again, we are already in the balance sheet. No, the net income should be in income statement, right? So we have the net income we have used before. Okay, so it's equal to the net income over the equity, and then we've used the equity before as well. Okay, and then we have our equity here, and then that's your return on what you own in the company. Okay, to remove. Okay, and then this number is a percentage as well. So okay, so your return on equity is 34%, which is actually very good. It means that your assets in the business are actually producing revenue. So the final number is the current ratio, which is basically the current assets divided by the current liability. In other words, it's gonna be equal. The current assets are the money that are gonna be converted into cash in the next 12 months, and the current liability is the total money that are gonna be out of the business or paid off or paid something in the next 12 months. Okay, so to calculate in balance sheet, as you might figure out, most of the numbers we want, it's on the balance sheet. So okay, we have to find the total current assets. So in the balance sheet, if you go to the assets, we have the current assets, again in billions because it's in thousand. Okay, and then divided by the total current liabilities. If I see the liabilities, and then I have the current liabilities. Paste. Okay, it should be income. Okay, and so we have the current ratio of 1.8, which means for every $1.83 the company is gonna receive, they only owe $1 out. So guys, thank you for watching. Please like the video if you found the information valuable, and consider subscribing to the channel if you want to see more content like that.